All right. Once again, hello everybody. I'd like to welcome you on our first educational webinar. The webinar name is Basics of Forex Trading. My name is Yury Safronau. I'm an A2Zmarkets.com chief currency strategist and the person behind the daily free Forex signals on A2Zmarkets.com. I have a PhD degree in finance and I work as an independent equity manager. I have extensive experience in trading stocks, crypto, and Forex since 2009. First of all, I'd like to tell you that the webinar is sponsored by Capex.com. Let me briefly introduce you the company. All right. Capex.com is a global brand established in 2016 with the goal of making online trading more accessible and rewarding for people worldwide. The company blends technology with a customer-centered, educational-oriented approach to create a true one-of-a-kind trading experience. As a strong supporter of transparency and trust, Capex.com ensures the very best standards of safety for your funds. That's why Capex.com keeps them safe in the world's largest banks, protected by high-end technology and secure connections. Additionally, the company only allows internationally recognized deposit and withdrawal methods. Capex.com brands are regulated by the world's most important authorities, including CISEC, FSCA, and ADGM, and registered with national authorities in countries all over the world, using intelligent technology to simplify your decisions. All right. Identify and make the most out of every opportunity in our powerful platforms, equipped with a full set of award-winning tools. With the company, you will enjoy lightning fast and reliable trade execution spreads, risk management tools, and for protecting your funds. Advanced charting options for the most informed trading decisions, powerful research tools in collaborations with award-winning platforms such as Trading Central and TipRanks. Capex Academy help you to become a better trader. Capex Academy helps traders to improve their trading success for maximizing your potential. The company always delivers the highest quality resources and learning tools such as in-depth video tutorials, both for the novice and advanced trader, daily market news, and commentary for the most informed trading decisions. Featured articles on the key trading events, premium webinars, and seminars for all skill levels. All right. Before we start a webinar, let me jump to the disclaimer. Let me briefly mention the disclaimer. AE.capex.com is a website managed by Keyway Markets Limited, a company limited by shares incorporated under the law of Abu Dhabi Global Market and regulated by ADGM Financial Services Regulatory Authority. The information presented in the webinar does not intend to constitute investment advice or an offer or solicitation to transact in any financial products offered by the Keyway Markets Limited. The information presented is only provided as an educational material and general marketing communication for information purposes only. It does not have regard to the specific investment objectives, financial situation, or the particular needs of any recipient. Participants should not rely solely on the information presented herewith and should do their own research, analysis, or speak to their own professional advisor. The content of the webinar is generic and does not take into consideration individual personal circumstances, investment experience, or current financial situation. Keyway Markets Limited does not influence nor has any input in formulating the information centered in the webinar. Therefore, Keyway Markets Limited shall not accept any responsibility for any losses of traders due to the use of the content of the information presented. If you are not a client of Keyway Markets Limited, please note that there is no obligation to purchase the services of the company. Past performance is not a reliable indicator of future results. Leveraged products are complex instruments and come with a high risk of losing money rapidly due to the leverage. All right. Let me finally start the educational part of the webinar. And the first question is, what is actually Forex? The foreign exchange market is the place where currencies are traded. Currencies are important to most people around the world, whether they realize it or not, because currencies need to be exchanged in order to conduct foreign trade and business. If you are living in the UAE and want to buy chocolate from Swiss, either you or your company that you want to buy chocolate from has to pay the Swiss for the chocolate in Swiss francs. This means that an UAE importer would have to exchange the equivalent value of dirhams into Swiss francs. The same goes for traveling. A Spanish tourist in China can't pay in euros to see the Great Wall because it's not the locally accepted currency. As such, the tourist has to exchange the euros for the local currency, in this case, the Chinese yuans, at the current exchange rate. The need to exchange currencies is the primary reason why the Forex market is the largest, the most liquid financial market in the world. It dwarfs other markets in size, even the stock market, with an average traded value around 5 trillion per day. The one unique aspect of the international market is that there is no marketplace for foreign exchange. Rather, currency trading is considered electronically over the counter, which means that all transactions occur via computer networks between traders around the world, rather than on one centralized exchange. The market is open 25 hours a day, 5.5 days a week, and currencies are traded worldwide in major financial centers such as London, New York, Tokyo, Zurich, Frankfurt, Hong Kong, Singapore, Paris, and Sydney, across almost every time zone. This means that when the trading day in the US ends, the Forex market begins anew in Tokyo and Hong Kong. As such, the Forex market can be extremely active any time of the day, with the price quotes changing constantly. So once again, Forex market is the largest financial market in the world, trading around 5 trillion each day. Trading in the Forex is not done at one central location, but is conducted between participants by phone and electronic communication networks, ECNs, in various markets around the world. The market is open 25 hours a day because currencies are in high demand. The international scope of currency trading means that there are always traders across the globe who are making and meeting demands for a particular currency. Currency is also needed around the world for international trade by central banks and global businesses. Central banks have particularly relied on foreign exchange market since 1971, when fixed currency markets ceased to exist because the gold standard was dropped. Since that time, most international currencies have been floating rather than tied to the value of gold. Economic and political instability and infinite other perpetual changes also affect the currency market. Central banks seek to stabilize their currencies by trading it on the open market and keeping a relative value compared to other world currencies. Businesses that operate in multiple currencies seek to mitigate the risks of doing business in foreign markets and hedge currency risks. Businesses enter into currency swaps to hedge risks, which gives them the right but not necessarily the obligation to buy a set amount of foreign currency for a set price in another currency at a date in the future. They are limiting their exposure to large fluctuations in currency valuations through this strategy. The ability for the Forex to trade over 24-hour period is due in part to different international time zones and the fact trades are conducted over a network of computers rather than any physical exchange that closes at a particular time. For instance, when you hear that the US dollar closed at a certain rate, it simply means that was the rate at market close in New York. That is because currency continues to be traded around the world long after New York close, unlike securities. Securities such as domestic stocks, bonds, and commodities are not relevant as in need for the international stage, and thus are not required to trade beyond standard business day in the issuer's home country. The demand for trade in these markets is not high enough to justify opening 24 hours a day due to the focus on the domestic market, meaning that is likely that few shares would be traded at 3 a.m. in the US. All right. So, how does Forex market work? The Forex market can be split into three main regions: Australia and Asia, Europe and Americas, with several major financial centers within each of these main areas. For example, Europe is comprised at major financial centers such as London, Paris, Frankfurt, and Zurich. Banks, institutions, and dealers all conduct forex trading for themselves and their clients in each of these markets. Each day of forex trading starts with the opening of Australasia area, followed by Europe and then North America. As one region's market closes, another opens or has already opened and continues to trade in the forex market. These markets will open overlap for a few hours, providing some of the most active period of forex trading. So, for example, if a forex trader in Australia wakes up at 3 a.m. and wants to trade a currency, they will have to be able to do so through forex dealers located in Australia or Asia. But they can make as many trades as they want through the European or North American dealers. Currency is a global necessity for central banks, international trade, and global businesses, and therefore requires a 24-hour market to satisfy the need for transactions across various time zones. In some, it's safe to assume that there is no point during the trading week that the participants in the forex market will not potentially make a currency loss. All right. So, what moves currencies? The foreign exchange market is comprised of currencies from nations all over the world, given the unique and complex nature of each and every economy around the globe. It is an impossible task to identify all the factors that drive currency prices. However, the factors that are I will speak right now will give you a good starting point for gaining an understanding of the type of factors many would consider the primary drivers. All right. The first one is economic releases. First of all, An oversimplified concept that is important to understand is that capital flows into economies that are considered safe, stable, and growing. Economic releases can be, though, of as real-time reports that give investors a glimpse into the underlying performance of the nation's economy. These reports are usually published periodically by government agencies or private organizations, although there are numerous policies and factors that can affect a country's performance. The factors that are directly measurable are included in economic reports. Having a strong understanding of economic events allows investors to compare one country's performance against others around the globe. Before we jump into some examples of specific releases, it's important to know that there are many economic calendars made freely available online to track the release of economic announcements. Many even highlight announcements based on their likelihood that will impact the exchange rate. Here are some of the most common economic releases that investors pay attention to. The first one is GDP, or Gross Domestic Product. GDP is a report that outlines the monetary value of all the finished goods and services produced within a country during a specific time period. GDP is one of the most watched metrics in Forex trading because it's a clear indicator as to whether the economy is growing or shrinking and how much it's changing relative to their opinions of analysts. Non-farm payrolls. Non-farm payrolls figures refer to any job in the economy with the exception of farm work and other situations such as those employed within the military and intelligence services. These release hold such influence because it provides a gauge for investors in determining whether corporations are hiring. When reports suggest that non-farm payrolls are improving and strong, it can be interpreted to mean that the companies are growing and that newly hired employees have money to spend, which will in turn fuel broad economic growth. Growing workforces and a strong economy will often lead to a strengthening currency. The next one is retail sales. The retail sales is a very closely watched report that measures the total receipts of the dollar value of all merchandise sold in retail stores in a given country. The report estimates that total merchandise sold by taking sample data from retailers across the country. Because consumers represent more than two-thirds of the economy, this report is very useful to traders to gauge the direction of the economy. Also, because the report's data is based on the previous month's sales, it's a timely indicator. Unlike the GDP report, which is a lagging indicator, the content in the retail sales report can cause above normal volatility in the market. The information in the report can also be used to gauge inflationary pressures that affect Fed rates. Industrial production. The Industrial Production Report, released monthly by the Federal Reserve, reports one of the changes in the production of factories, mines, and utilities in the US. One of the closely watched measures included in this report is the capacity utilization ratio, which estimates the level of production activity in the economy. It is preferable for a country to see increasing values of production and capacity utilization at high levels. Typically, capacity utilization is the range of 82 to 85% is considered tight and can increase the likelihood of price increases or supply shortages in the near term. Levels below 80% are usually interpreted as showing slack in the economy, which might increase the likelihood of a recession. The next one is PMI or Purchasing Managers Index. The Purchasing Managers Index is derived from reports from purchasing as executives from a variety of corporations across the manufacturing sector. The PMI figure is calculated based on five major indicators: new orders, inventory levels, production, supplier deliveries, and employment. The primary purpose of this indicator is to provide investors with a snapshot of the state of the manufacturing sector and whether it's expanding or contracting. Okay. Other common economic releases include CPI or Consumer Price Index, retail sales, durable goods orders, housing starts, existing home sales, and unemployment rate. So far, so good. We've moved to the question, what moves currencies? The economic releases I was talking about a while ago are not the only factors to watch. These are also several meetings around these events that provide quotes and commentary which can affect markets such as much as any report. These meetings are often called to discuss interest rates, inflation, and other issues that affect currency valuations. Even changes in wording when addressing certain issues, such as comments from the chair of the Federal Reserve on interest rates, for example, can cause market volatility. The stock market is often regarded as a barometer to a country's economic performance. Strong stock markets are often indicators of strong and growing economies, which in turn leads to increased foreign investment and demand on the currency. The performance of major global financial markets is a key indicator used by forex traders. Another one is international trade or balance of trade. The interconnectedness of global economy means that the status of international trade is a key indicator of an economy's competitive advantage. The balance of trade is the difference between a country's imports and its exports. In a common metric used by conjunction with other data points by forex traders for determining a country's economic health in general, investors get concerned when a country's imports are larger than exports. Known as a trade deficit over a prolonged period of time, persistent trade deficits are closely watched because they can put a nation at risk of future currency devaluations. At this stage, the important thing to understand is that data provided uh, about the balance of trade and the state of international trade is generally are commonly used by conjunction with other economic data to determine a nation's economic health. Next one is a difference in interest rates. Varying interest rates among lenders in different nations is one of the primary drivers of currency prices. The concept is discussed in more detail later, but we are at this point need to understand that generally speaking, foreign capital tends to flock towards a higher interest rates, which in turn causes exchange rates to rise. The next one is politics. Forex traders try to stay as informed of political news and events as possible. Factors such as newly elected leaders, changes in fiscal and monetary policy decisions, and overall openness to trade and commerce impact the performance of the national economy and therefore its currency. One example that is worth noting is Brexit, which was the vote for a planned withdrawal of the United Kingdom from the European Union, which sent the British pound to a multi-decade low due to uncertainty surrounding the UK's economic prospects. While this is a drastic example of the impact of politics can have on currencies, sometimes even comments from nations leaders or hints of an upcoming market can trigger large price swings. Understanding that factors that move currencies is an important first step to becoming a successful forex trader. Simply following global news and events, reading analysts and reports, examining reliable commentary, and analyzing chart patterns can help forex fundamental analysis gain a better understanding of long-term market trends and allow short-term traders to profit from extraordinary happenings. If you choose to follow a fundamental strategy, be sure to keep a calendar that highlights important dates so you know when these reports are released. Your broker may also provide real-time access to such information. Now let's dig in a little deeper into the basics of Forex. So what is a currency pair? In forex market, currency trading is considered most frequently among the US dollar, the Japanese yen, the euro, the British pound, and the Canadian dollar. A currency pair such as Euro-USD, for example, represents the relationship between the euro and the US dollar. The first currency is the base currency, and the second currency is a quote currency. So to buy Euro USD at 1.12 on a trade for 100,000 currency units, you would need to pay 112,000 dollars for 100,000 euros. Four major currency pairs are the most traded and have the highest volume. These are known as major pairs. They are Euro US dollar, US dollar Japanese yen, British pound US dollar, and US dollar Swiss franc. These pairs all contain the US dollar. In yen-denominated currency pairs, a pip is only two decimals in place, such as USD/GPY. This is 1/100th of a cent. Currency is often traded in lots that are 1,000 units of the underlying currency. So what is a PIP? A PIP is an acronym for Price Interest Points. Is a tool of measurement related to the smallest price movements made by any exchange rate. Currencies are usually quoted to four decimals places, meaning that the smallest change in a currency pair would be the last digit. This would make one pip equal to 1/100th of the percent or one basic point. For example, if a currency pair was quoted earlier to change from 1.1200 to 1.1205, this would be a change of 5 pips. To get the value of one pip in a currency pair, an investor has to divide one pip in decimal form by the current exchange rate and then multiply that number by the notional amount of the trade. Keeping with our earlier example of Euro-USD currency pair, let's say that the value of one pip is in US dollars is 8.93 euros. To convert the value of the pip in US dollar, just multiply the value of one pip by the exchange rate. So the value in US dollars is obviously $10. The value of one pip is always different between currencies because the differences between the exchange rates or various currencies, a phenomenon does occur when the US dollar is quoted as a quote currency. When this is the case with a notional amount of 100,000 currency units, the value of the pip is always equal to $10. So what does leverage mean? Leverage results from using borrowed capital as a funding source when investing to expand the firm's asset base and generate returns on risk capital. Leverage is an investment strategy of using borrowed money, specifically the use of various financial instruments or borrowed capital to increase the potential return of an investment. Leverage can also refer to the amount of debt a firm uses to finance assets. When one refers to a company, property, or an investment as a highly leveraged, it means that item has more debt than equity. Investors who are not comfortable using leverage directly have a variety of ways to access leverage indirectly. They can invest in companies that use leverage in the nominal course of their business to finance or expand operations without increasing their outlay. So let's see some examples of leverage. A company formed with an investment of $5 million from investors. The equity of this company is 5 million. That is the money the company can use to operate. If the company uses that financing by borrowed 20 million, now it has 25 million to invest in business operations and more opportunity to increase value for shareholders. An automaker, for example, could borrow money to build a new factory. The new factory would enable the automaker to increase the number of cars it produces to increase profits. Downside of leverage. Leverage is a multi-faced complex tool. The theory sounds great, but in reality, the use of leverage can be profitable, but the reverse is also true. Leverage magnifies both gains and losses. If an investor uses leverage to make an investment and the investment moves against the investor, these or her loss is much greater it would have been if he or she had not leveraged the investment. In the business world, the company can use leverage to generate shareholder wealth, but if it fails to do so, the interest expense and credit risk of default destroy shareholder value. So there are two ways to approach Forex trading. Analysis can seem like an ambiguous concept to a new Forex trader, but it actually falls into three basic types. Um, the first one is technical analysis. Technical analysis comes in the form of both manual and automated systems. A manual system typically means a trader is analyzing technical indicators and interpreting the data into a buy or sell decision. An automated trading analysis means that the trader is teaching the software to look for certain signals and interpret them into executing buy or sell decisions. Where automated analysis could have an advantage over its manual counterpart is that it's intended to take the behavioral economics out of trading decisions. Forex systems use post-price movements to determine where a given currency may be headed. Given the scale of the Forex market, it's quite common for investors to use charts and various tools of technical analysis as the basis of making buy and sell decisions. More specifically, given the liquidity of the the market and broad number of fundamental factors that influence prices, it is warranted to assume that all salient data is already priced into exchange rates. Okay. At this point, it's important to understand that since so many rely on the chart, that common signals can be enough to trigger a move in the underlying currency. The fundamental analysis is often used to analyze changes in the forex market by monitoring figures such as interest rates, unemployment rates, gross domestic products, and other types of economic data that come out of countries. For example, a trader conducting a fundamental analysis on British pound USD would find information of the interest rates in the UK very useful, as well as in the US. These traders would also want to be on top of any significant news releases coming out of the UK and US to gauge the relation to the health of their economies. Obviously, you understand that there are pros and cons of trading forex. Right now, I would like to mention some of the most common process of trading forex. Among the pros of trading forex, I would highlight the following. Low cost. Forex trading can have very low cost. Brokerage and commissions. There are no commissions in real sense. Most forex brokers make profits from spreads between forex currencies. Compare that to equity or other securities trading where the brokerage structure vary widely when a trader must take such fees into account. Suits varying trading style. The forex market run all day, enabling traders at one's convenience, which is very advantageous to short-term traders who tend to take positions over short durations, say a few minutes to a few hours. Offers very high liquidity. Compared with any other financial markets, the forex market has the largest number of market participants. This provides highest level of liquidity, which means even large orders of currency traders are easily filled efficiently without any large price deviations. This eliminates the possibility of price manipulation and price anomalies, thereby enabling tighter spreads that lead to more efficient pricing. No central exchange. Being an over-the-counter market operating across the globe, there is no central exchange or regulator for the forex market. Various countries' central banks occasionally interfere as needed, but there are rare events occurring under extreme conditions. Most such developments are already perceived and priced into the market. Such a decentralized and deregulated market helps avoid any sudden surprises. Volatility. Volatility is a trader's friend. The major currencies frequently display high price swings. If traders are placed wisely, a high volatility assists in enormous profit making opportunities. A variety of pairs to trade. There are 28 major currency pairs involving 8 major currencies. Low capital requirements. Due to tight spreads in terms of pips, one can easily start forex trading with a small amount of initial capital. Without more capital, it may not be possible to trade in other markets, like equity, futures, or options. Ease. There are hundreds of forex technical indicators to draw on the short-term trades and several fundamental analysis theories and tools for long-term forex trading, creating enormous choice for traders with varying levels of experience to make a swift into forex trading. All right. So far, those were main process of trading forex, and now we jump to some cons. Among the cons of trading forex, I'd like to mention four of them. Lack of transparency. Due to the regulated nature of forex market dominated by brokers, one actually trades against professionals. Being a broker driven means that the forex market may not be fully transparent. A trader may not have any control on how his trade order gets fulfilled, may not get the best price, or may get limited views on trading quotes as provided only by his selected broker. A simple solution is to deal only with regulated brokers who fall within purview of broker regulation, and the market may not be under control of regulators, but the activities of brokers are. I may make a short remark that the COPEX.com is regulated in UAE by Abu Dhabi. It's regulated in London, and it's also have a license of CISEC. Complex price determination process. Forex rates are influenced by multiple factors, primary global politics or economics that can be difficult to analyze information and draw reliable conclusions to trade on. Most forex trading happens on technical indicators, which is primary reason for a high volatility in forex market. Getting the technicals wrong would result in a loss. High risk, high leverage. While a trader can benefit from the leverage, a loss is magnified. Forex trading can easily turn into a loss-making nightmare unless one has a robust knowledge of leverage, an efficient capital allocation scheme, and strong control over emotions. High volatility. There is no control over macroeconomic and geopolitical developments. One can easily suffer huge losses in the highly volatile forex market. If things go wrong with a particular stock, shareholder can put pressure on management to initiate required changes, and they can alternatively approach regulators. Forex traders have nowhere to go. All right, before we jump to a question section, let me show you several features of Copix WebTrader platform. And in order to do so, let me open the browser. All right, I was logged out. Not a problem. Let me type my login details. All right, perfect. I'm in. Copix WebTrader platform has integrated tools bringing together the knowledge, the skill, the market, and expertise. Let me just show you several very nice features which could help you improve your trading results. And these features only Capex.com has in their web trader platform. The first one, which I would like to show you, is called Insider Hot Stocks. Let me push this button. It would open me. Yes. You can develop a broader perspective on the market, which is handy tool showing you the high-level executives' transactions on their company stocks. See how the performance of each stock has been affected by the insider transactions. Access a detailed transaction history and check out who's been buying or selling and the total trading volumes. Understand why insiders are buying or selling their company stocks and improve your trading experience. Okay. The next feature is called Daily Analyst Ranking. Spot relevant market movements by checking what top-rated financial analysts, according to TPRanks, declare about the price evolution in stock market. Find out what stocks the experts recommend and what are their price expectations. Learn new trading strategies and expand your investment options. Create a better risk management strategy backed by analyst data. All right. The next one is called Blogger Opinions. Discover the best performing financial bloggers according to TPRanks and start monitoring them to get valuable stocks information. Make good use of the tool that measures the performance of 50,000 financial experts featured in websites such as Seeking Alpha, Motley Fool, or Investor Place. Find out what's trending and the general bloggers' consensus, bearish, bullish, or neutral on the stocks that engage your interest. Follow the stock picks that interest you and receive notifications whether your favorite bloggers change their positions. Right? The next one is called hedge funds activity. Um, See how what professional hedge funds managers are investing in and how their hedge funds fare against each other, gain insights into the overall sentiment of fund managers to get a more accurate view to the market, create new trading strategies and plans based on extensive information, track a summary of funds activity directly on the trading platform. Okay. The next one is called a news sentiment. All right. Um, Discover what's been relevant in the media for your favorite stocks in the previous week. See how positive, negative, or neutral press coverage affects the market sentiment. Find out how world events impact share prices. Get an overview of the market buzz surrounding each stock and spot bearish, bullish trends. Okay. Another cool feature that I found in Copex.com platform is called Trading Central. Trading Central is a service which provides you um, an information about their support, resistance levels, and pivot points levels. But before I found it very useful that Capex.com integrated it directly in their platform. You don't need to log out separately, but instead you can turn this feature on right here. Okay, and every chart would show you the trading central, minimize, pivot points levels, support and resistance directly on the chart. So when you, let's see, let's make it a little bit bigger. All right. You can see those support 1, support 2, pivot, resistance levels directly on the chart. And when you click some other chart on a different stock, it would draw those trading central lines automatically, which is very convenient and time saving compared to logging in into trading central website. Let's open a USD to see how it works. Yes, it works perfectly. Like you see in here, today your USD touched pivot level and retraced back. Yeah, okay. So it works very nicely, and the thing that Copics.com integrated it into their web trader platform is really, really convenient. So now, overall speaking about the Trading Central, the company provides trader with a broad range of technical indicators usable with CFDs, shares, commodities, indexes, forex, ETFs, and bonds. Um, let's just briefly describe the main uh, instruments which Trading Central has. So Trading Central indicates whether an instrument is forecasted to remain bullish or bearish throughout the day, highly useful for traders when shaping their intraday trading strategies and decisions. The pivot level, which I was talking about before, indicates the price point at which an instrument is predicted to change from bullish to bearish and vice versa. Pivot points price may help traders identify potential buy-selling opportunities, which help to build an effective trading strategy. Trading Central preference indicates Trading Central's preferred trading strategy at a particular moment, including preferred trade duration, long, short, when the instrument reached a specific level. Okay. Alternative scenario indicates an alternative trading strategy to green analysis. Data can include the price point at which an instrument may include signs of falling and the likelihood of falling further, highlighting the target price points and look for it. Like you see here, there is this short comment, and they show that their preference is short positions below 1.1940 with target of 1.1880 and 8065, and the alternative scenario is breakout above 1.1940, which is valuable information for a beginning trader to at least take a look at the chart and see where those levels are and what can a currency pair be doing in future. So regarding the support and resistance levels, those S1, S2, S3, R1, R2, R3, the resistance highlights price levels at which an instrument price may continue to rise. These may potentially show when an asset hits a low price before it may continue to rise. And the support reveals price levels at which an asset may continue to fall. These can be very valuable for traders looking to sell when an asset approaches a support level. So far, so good. Those were the main features of Capex.com web trader platform. Obviously, you can use the indicators, you can use instruments, indexes, you can choose like top rated, top stocks, and top failures, some instruments, and so on, and also cryptocurrencies in here. But those features are typical for a trader platform. But the features which I was highlighting, those insider hot stocks, daily analyst rankings, blogger opinions, hedge funds activity, news sentiment, and integrated trading central software are really nice and are not really typical for most forex brokers. So those features, mm, I like that they have it in here. All right, so far so good. That's the end of the educational part of the webinar. I'll be happy to answer your questions. So feel free to type your questions in the in the question section, I'm sorry, where you typed yes, Y, or plus sign when I was asking you to confirm that you can hear me properly. So feel free to type any questions you have. I'm here with you. to answer those questions. Mm-hmm. We do. All right. The question is about regulation. How is a broker regulated? Um, So there are, in general, it's not my specialty to be honest. The regulation of broker companies. I have never worked for a regulator. That is why I can only mention some general information about regulation. So first of all, what you need to know is that there are strict parameters which the regulator says that the broker needs to obey to. Let's say they require them to deposit some amount of money in local banks, not in offshore countries, and the broker is obliged to do so. They also require them to, let's say, to hold an office in the country of where the broker is regulated, let's say in UAE, right? If they're regulated by UAE Commission, um, uh, that helps you to understand that the company is legit if they have a local office in the country of origin, right? At least you can come and in the worst case scenario and speak with real people because in my experience I started to trade in 2009. There was a time when there was lack of regulation in forex market and I was trading with some shady broker, and I was making money with them. But then when I tried to withdraw, they said that you need to provide us some proof of your residence, which I did them. The proof that your passport is not fake. I also went to a lawyer, and the lawyer confirmed it. Then they asked some other bunch of documents. So I was thinking, why is the withdrawal process is so complicated? But the idea is was that they were not intended to send me my money, but there was where the intent was um, to extend the time which I tried to withdraw my funds. And in the end, it took me like 3 months to provide all bunch of documents which they requested. I successfully did them, but they didn't withdraw. They simply stopped to reply to my messages and my calls. All right. It was said on their website that the company is head office is in Vienna, in Austria, and at that time I needed to go to Vienna, so I went to Vienna. I went to the building, which they said their head office is there. I entered the building and asked the guy in the front desk that I need this company. And the guy said, "I don't know this company. It's not here, and it never was here." So those fake brokerage companies which don't have regulation, with fake websites, it was typical at that time, and that is why I would like to tell you that you only need to trade with regulated broker, and also it's good to check the company on the regulator's website, not only on the website of the company, like copex.com, you go, you see that it's regulated by, let's say, CISIC. You go on CISIC website and check if it has this company really. But because some shady brokers, they claim that they have a license, but if you check it on the regulator website, they don't really have this license. The next question is which currency pair would I recommend to trade for a beginner? Um, As a beginner, I would suggest you to trade major currency pairs, as we have already discussed the major currency pairs, Euro USD, Euro US dollar, British pound US dollar. Uh, we can say that it's Australian dollar US dollar, New Zealand dollar US dollar, Japanese yen US dollar. Those currency pairs are considered to be majors. I would recommend trading those because, first of all, spreads are lower for major currency pairs, and secondly, there is much more information and many analytical articles, um, some technical analysis made for the major currency pairs. And if you are a beginner, I would suggest to trade those currencies um, just to understand how the market works. And if you are trading on real funds, um, I would suggest to trade those major currency pairs because of low spreads. And if your broker charges a commission, usually this commission is also lower for majors. Okay, we have another question. Is it better to start with Forex or stocks market? Obviously, I would suggest to start with Forex. As we have already discussed the process of trading Forex, it's very low cost. Let's say if you are planning to trade stocks, it would require larger margin, larger capital. You obviously cannot trade stocks with $10 on your balance, but it's possible to trade Forex if you have only $10 on your balance. Now, Forex trading is open 5 days a week, 24 hours a day. Stocks market pretty much, if we're talking about the US stocks market, NYSE or Nasdaq platforms like New York's stocks um, exchange, it would it is open 6.5 hours a day, 5 days a week. And let's say today there is a holiday in US, the stock market is closed. Tomorrow there is a short day in the US, and the stock market would be open only 3.5 hours. So you see that it's much easier to trade when the market is open 24 hours a day and then it closes in and operates only 6.5 hours a day. Also, the next point is the high liquidity. When you're trading stocks, there are some stocks with a very low liquidity. And you, let's say you bought a stock and you want to sell it, but you don't have any offers to sell for a good price, and that is why you have to sell it very cheap because there is not enough liquidity. The liquidity also results in a higher spread. Obviously, if you trade some very popular stocks like Alibaba, Apple, Amazon, Google, etc., there would be enough liquidity. But if you choose some um, stocks which don't have enough buyers or sellers, you could end up in a situation when you hold a stock, but you have nowhere to sell it. So also volatility, there is a volatility on Forex and stock market as well, but let's say that volatility is more stable on Forex than it's on stocks because different stocks have different volatility. if you let's say an average volatility, the ATR of your USD is around 80 pips per day. So for some popular stocks like Apple, Google, Amazon, it can be up to $10. And there are some stocks which move like 10 cents a day. So is it really possible to make money on those stocks? I seriously doubt that, but maybe you can, but it really depends. So if you are a beginner, it's much better to start from Forex than trading stocks because the stocks market is regulated. It's not as easy to start. It requires more capital, and it also requires you to have more knowledge to trade than Forex. Okay. I don't see that we have any other questions. So far, so good. I'm gonna end the webinar. Let me tell you that it was a pleasure to host this meeting for you. I hope that you gained some valuable information, and I really hope that the information I gave you would be helpful for your future trading. It would gain your additional profits and it would make you a bit happier in the end. So once again, thank you very much for spending time with me. I hope to see you on our next webinars, which should come in the nearest future. And I really hope you enjoyed this information. And thank you very much for viewing and listening this webinar. Bye bye.